finance, a la shmup. What is liquidity preference? Yeah, well, liquidity is a good thing. You want it. Being liquid means that you have cash, which gives you options to, buy stuff. And yeah, even the Amazon River shops at Amazon. All right, so if your flavor of investment has a liquidity preference over someone else's, then your investment, all else being equal, is preferable. See the liquidity preference? Specifically, if you have liquidity preference, and usually this is found in the form of early stage venture capital investor term sheets who are investing in companies in the form of convertible preferred stock, like it converts into common at the IPO or something like that, then you get paid before everyone else gets paid, at least in this form of stock, if the company gets sold. All right, well, technically, that is, if the company is sold and your convertible preferred hasn't converted into common shares yet because the company didn't go public. But let's think about the example where the company had raised $12 million in preferred stock, which all had a liquidity preference over and above common, and then the whole company was sold for just $15 million. Well, then those with liquidity preference would get liquid first, i.e. they'd get their $12 million. Then the remaining $3 million would be sprinkled around everyone else who is due the dough. Plus, any dividends or accrued assets that have come our way otherwise. And yes, technically, debt holders get paid ahead of the various series preferred investors who then get paid ahead of the common shareholder, but that's a different video. All right, so when it comes down to it, you want to have liquidity preference. Clearly, I prefer to be liquid myself.